Welcome to this Click Explains video, done in my lockdown version 3 format. Hopefully I'll be back to the studio sometime soon. So the topic this time is value investing obsolete? Now the background to this particular video topic is this. Investing is broadly divided, at least by the media, into two camps. One is growth investing as it's known, and the other is value investing. And some critics are now wondering whether the latter actually still works. So let's take a look at why and what investors should make of this debate when it comes to building portfolios. So what is value investing first of all? A very quick snapshot on a vast body of material on this subject. So in a nutshell, value stocks are generally also known as counter-cyclical or defensive. And they have certain criteria. They tend to be relatively low or lower growth. They tend to be high or higher yield. And they're generally not associated with sectors that roar away as the economy rises out of recession into a new economic growth phase. Value investors ideally buy them, as the name suggests, when they're cheap and hold them for the long term. And they generally base their investment strategies around the works of some very famous investors. If you go back far enough to security analysis, the work of Benjamin Graham, and then one of the most successful investors, arguably of all time, Warren Buffett, applies value investing principles on a regular basis. Now, what are value sectors? Well, this is a moving feast to some extent, but essentially, without a universal definition, we can say they tend to be lower growth or lower growth rate type sectors and with higher than average dividend yields, on the basis that if a company is not delivering stellar growth, investors will ask the question, well, what is it delivering? And often dividend yields can be a valid answer. So examples could and usually do include banks, energy stocks, insurers, and utility companies, but I wouldn't say the list is exclusively limited to those. And on what basis are we saying these are value stocks? On what basis are they screened? Well, typically value investors use a mixture of price-based ratios, so price to earnings, PE, price to book, PB, plus dividend and cash flow yield type metrics. So those, if you like, are the bread and butter. By no means the only ratios, but they're the bread and butter of value investing. And those kind of roll your sleeves up, get into the accounts, work out an intrinsic value for a business, then compare it to the price you'll need to pay to buy it today, and look for a bargain, if you want to see it that way. That is the kind of mindset of value investing. So what's gone wrong? And over the last decade, really, anyone who has exclusively pinned their colours to the value investing mast has had a pretty rough time of it, as the technology stocks, the biotechnology stocks, the super sexy banking, new banking stocks, if you like, kind of roared away. Well, critics point to around 5 different problems, and whether you weight these equally or give them different weights is down to you. But essentially, critics of value investing say it's gone wrong a little bit for 5 quite important reasons. Number 1, low interest rates around the world, central bank record low interest rates, have pushed investors up the risk curve, as it's known. In other words, with interest rates so low, value investors have had a hard time of it, as other investors have said, well, in order to get a half decent return, I need to be prepared to take some more risk. And if you're talking risk in the context of selecting stocks for a portfolio, it's going to tend to move you towards growth rather than value. Number 2, we've not really seen a proper recession for over a decade, and these 2 points are connected. Quantitative easing, low interest rates, central bank actions, if you like, to stave off a recession have to a degree been successful. And the problem with that is it's recessions that generally create these enormous opportunities for value investors. You get situations where stocks trade, whole sectors trade way below what a value investor would say is the kind of intrinsic value of the business that they're looking to buy. We haven't really seen those conditions for quite some time. Number 3, everyone has been discussing what I'm discussing here. When will the turning point come for value? And because people have been discussing it, everybody kind of knows about the debate. And as a result, value isn't quite as cheap, some would argue, either on a funds basis or on a single stock basis as perhaps it might be. In other words, valuations have been made that little bit less attractive, which takes away some of the momentum to move into value stocks, one could argue, simply because of the amount of debate churning around about when is it going to be time for value to make a return. 4. Passive investing, some would say, has broken, as it was once famously called, the weighing machine. In other words, the rise of passive investing through index-based products, exchange-traded funds and so on, has essentially driven the market up with very little discernment between value and growth. Passive investing built on indices buys essentially what is in the index, and the more important the stock is in the index, the more money will pile into it. So some would say that the market has lost a little bit of its ability to distinguish value from growth because huge numbers of passive funds will pile into a stock whether or not it's good value, based simply on whether it's prominent in an important index. And number 5, there are some who say that innovation and the march of technology and what we've seen happen during 2020, working from home, electronic payments, the acceleration of some key trends in 2020 is rendering value stocks a little bit obsolete. They'll never be good value because quite a few of them, some would say traditional banks, for example, traditional energy companies, are actually in danger of going the way of the dinosaurs. Now, faced with all this barrage of criticism around value investing, what should investors trying to build long-term portfolios actually do? Well, I think the answer is, first of all, recognise that the distinction between value and growth is, to some extent, a device and a bit of a distraction. As Warren Buffett once said, the two things are actually fundamentally joined at the hip. Investors need well-diversified portfolios containing stocks that deliver different outcomes. So it's pretty dangerous to say, I only invest in growth stocks, I only invest in value stocks. A good portfolio will contain a blend of the two, albeit it may well not be a 50-50 blend, depending on where we are in the economic cycle. And it's also important to remember that many of value investing's focal points apply universally. There are things value investors do that all investors should do, and woe betide growth investors who get carried away with the technology, biotechnology, banking story, if you like. That's new style banking. That's Monzo style banking, not necessarily, say, Lloyd's. Woe betide people who get carried away with those arguments and start to ignore some of the fundamentals. Now, what are those fundamentals? Well, all good stocks should have certain things in their favour. Strong management teams with good track records. I'm going to fly through this. Some stability and predictability in earnings and cash flow. And robust balance sheets. And there are plenty of growth stocks around in the technology sector this time which have those criteria. Less so at the end of the dot-com boom, going back some time now, but more so today. So these are not features that you can say just apply to value stocks anymore. And the key question I would suggest then becomes, is this stock, whatever this stock is, good value at its current price? And this is where pure value investors may get left behind. In other words, simply looking for stocks that are cheap can leave you chasing a fairly small pool of relatively unloved stocks. I think that's too narrow a focus. As Warren Buffett put it, it is better to buy a wonderful company for a fair price than a fair company for a wonderful price. And that, I think, is the key to it. If you are a dyed-in-the-wool value investor, you will have had a pretty disappointing decade at least. The trick is to recognise that the world has changed to a degree. I don't think it's true to say that it's completely transformed, but it has changed, and therefore the lens through which you select stocks needs to change too. Any questions on what is a pretty large topic? editor@killick.com. And if you'd like to watch videos on some of the points I've covered fairly quickly here, then it would be killick.com/learn, and the shares tab is a good place to start. And if you'd like to read Mark Nelson's article about this debate within Confident, then you want to get hold of the winter 2020-21 issue. And again, if you email me, I can connect you to somebody who can provide that for you.